This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Now we're going to look at various methods that will enable us to reduce currency transaction risk. Transaction risk is by far the most important sort of currency risk in the exam. And here they are, the methods out here. It's probably relatively fair to say that certainly the first three, maybe even the first four there, are essentially internal, meaning you don't need a bank to be involved or financial markets to be involved. Once you go on to the last ones, then there's usually some financial sort of intermediary involved. So let's look at these. First of all, there's invoicing. That's a very simple trick. You will not experience any currency risk if you manage to invoice your customers in your currency and also be invoiced by your suppliers in your currency. So roughly speaking, for any transaction, one or other of the parties is going to be in their own currency. And then there is absolutely no risk if you're going to be, if you're a UK supplier and you bill your customer in pounds sterling, it doesn't matter what their currency does, they're going to have to pay you in pounds sterling. Now really, the person who's in their own currency, it's really a matter of haggling. You will haggle on the price, you'll haggle on how long you get to pay, and then finally you might haggle on whether or not you're invoiced in your currency or their currency. Very simple. If you can get it, essentially it's going to be free. Leading and lagging. Leading and lagging is the sort of games we all play when we're thinking of going on holiday. About a month before we depart, we begin looking into foreign exchange rates, and we think to ourselves, should I change my money into the foreign currency now or should I wait? If you think the foreign currency is going to become more expensive, for example, compared to the pound, if the euro was to go down from 1.4 to 1.2, then you would rush out and change now. Better to get 1.4 euros to the pound than 1.2. That's known as leading or accelerating. This gets rid of risk, which you've changed your money now. You know what your holiday spending money is actually going to cost you. You may of course get it wrong. On departure day, the euro might have gone from 1.4 to 1.5. You'd be kicking yourself, but that's not the point. The point is you have a definite expenditure, if you like, that could be fitted into a budget. If you thought the euro was going to get weaker, so from pounds to euro, it's going to go from 1.4 euros to the pound to 1.5, you get more euros to the pound, then you might consider lagging, changing the money at the last possible moment. This doesn't reduce risk. The currency might go the other way. You might only get 1.3 euros to the pound. You're actually gambling on this, hoping to second guess the market. And that is not really a successful way of eliminating risk. But leading is. Matching receipts and payments. So there's matching receipts and payments, there is netting and so on. They're all very, very similar, and sometimes I think that the terms are used rather interchangeably here. One way you can think about this is if you are a company, you're going to be receiving $20 million in 4 weeks and have to pay out $18 million in 5 weeks. What you would do is simply open a US dollar bank account, put the $20 million in, leave it there, and then in a weeks later you pay 18 million of that out. And it doesn't matter what the exchange rate does. You've got dollars in the bank to pay dollars to your supplier. It works best if you've got lots of inputs and outputs, lots of flows in and out. There's not much point maybe in getting $20 million now and not having to pay it out for another 9 months. It's just kind of slopping about there, not earning very much money. So lots of busyness, and in a group it often requires coordination, because quite often the part of the group which is importing is separate company to the part of the group which is exporting. And this is where a treasury department, which amongst other things will be looking after the exposure to foreign exchange risk, can help to coordinate matters. Netting receipts and payments, very, very similar here. Here we have two subsidiaries. C&D are respectively a South African and US-based subsidiary of a UK holding company. C owed £300,000 sterling to D, and the other way around, D owed C 220,000, and substantially these intercompany balances can be netted off. Don't make any transfer of currency except for 80,000, and again that's a way of avoiding having to translate the currency into your own currency or into another currency where you're at the mercy of the exchange rates. And finally, in what I call the internal methods, although maybe strictly it's not an internal method, you barter, you trade. So if I'm exporting, let's say machinery, let's say to Norway, and Norway, instead of giving me either Norwegian currency or UK currency, it could give me, let's say, wood. So it's a big forestry country. So we transfer the goods, and we would agree up front, what this machinery is worth in terms of pine logs or whatever it's going to be. And again, it kind of completely bypasses the whole currency markets. Ideally, you would maybe transfer stuff that you're actually interested in, actually dealing in, of course, rather than taking a gamble on the commodity price of wood. But counter trade is basically bartering. And then we come on to the first of our external methods, and this is a forward contract. Remember forward rates? They were a rate which was quoted to you and which was promised to you for the future. So if you know you have money coming in 3 months' time from America, go to the bank and negotiate a forward contract to change, let's say, $200,000 into your currency, and they'll give you a forward rate which is completely independent from the actual rate which may be applying at the time the money comes in. So again, you're really kind of guaranteed what amount of money you're going to be getting. It's important to realise that it is a binding contract. If you say to the bank, I'm getting $300,000 in 3 months' time, I want to bring it in and change it with you for pounds sterling, they will expect you to turn up in 3 months' time with $300,000. And if something were to happen, the deal, if the sale were called off and you didn't get $300,000, they would nevertheless expect you to deliver that $300,000, perhaps by going and changing sterling to dollars and then immediately changing it back to fulfill your forward contract. This is known as an over-the-counter, sometimes OTC, over-the-counter contract. You have to go to your bank and kind of personally negotiate it with the bank manager. It means it can be negotiated for very precise amounts of money and for very precise times, as well as kind of tailor-made. So let's see an example of this. And the first thing we need to do is really to see how the forward rates will be told you, how they could be specified to you. And the first and easiest way is that it could just be told you straight. It'll just say the 3-month forward dollar per pound rate is 1.5231 to 1.5425. This means if you go along with a pound in 3 months' time, they're going to be giving you that a number of dollars. So this one here is the other way around. So this is a guaranteed rate, and depending whether you're changing pounds to dollars or dollars to pounds, one or other of the rates will be applied in 3 months. Another way they can do it is like this. They give you kind of plus minus here. The 3-month forward rate is 1.5328 plus or minus 0.0097, and this essentially is going to give you the spread, this plus or minus here. So if you take the 1.5328 minus 0.0097, we come back to the lower one, and if it's plus, it comes to a higher one. But there's no particular mystery in that. It's easy enough to see what's happening. The third way in which you might be given information is a little bit more involved, just takes a little bit more skill. And here what we have is the spot rate, and these figures are different to the previous ones, you won't follow on. And then you're given what's called a margin, an adjustment that you have to make to the spot rate to get the forward rate. Two things to notice about this margin. First of all, this one in here is saying cents, C for cents. The margins are very small and usually are often given in a smaller denomination of the currency. And then it says DIS, which means discount. It could have said PM instead of DIS. That doesn't mean it's the rate you use in the afternoon, it means premium. And the trick here is that you do these discounts and premiums, you kind of do the opposite that you would naturally expect the words to mean. So if you say a price is at a discount, you take something off. If you say I'm going to put a premium on that price, you add something on. Here it's different. You add a discount and you subtract a premium. So what we have to do is just carefully line things up and decide whether to add or subtract. So if I take my spot rate here, and we have 1.5332 to 1.5465, and then we have the margin. That's 0.45 of a cent, so we have to go 0.0045 to 0.0063, okay? And it's a discount. That was only an example. It's a discount, so we're going to be adding it here. So we're going to have 8. Instead of I've added it right, and this one here is going to be 77351. So that is your 3-month forward rate, 1.5377 to 1.5228. So do remember this is the only one that's tricky. You add a discount, you subtract a premium to go from the spot rate to the forward rate using these margins. So here we have an example. The UK company has made a sale to a US company for 5 million. Payment will be received in 3 months. It wants to protect itself against exchange rate movements by taking out a forward contract to deliver $5 million in 3 months, and the 3-month rate is going to be that. And we can see immediately that the 3-month rate here, if we subtract that 0.006, we're going to get 1.5293, I think. If we add it on here, we're going to get 1.56, and it's going to be 50, I think 3. 1.5305. If this is the rate in terms of dollars per pound, this means if we go along with £1, it's going to give us this number of dollars. So this is pounds to dollars. This is going to be dollars to pounds. So this is the one that's going to be used, 1.5305. Let's just see that written out properly here. So here we have, we've got the range in here which I got in the previous situation. We're going to be using this rate 1.5305, and we're changing dollars into pounds. We're going to get many fewer pounds than dollars. We're going to be dividing that by that rate, and this is a sum which is nearly guaranteed. Again, it doesn't matter what the dollar pound rate does in those 3 months, we are guaranteed this rate, so it takes risk out of it. The only remaining risk is if that 500,000 doesn't turn up. Something goes sour in the deal and falls through, the transaction is cancelled in some way, yet we've entered into this binding contract here. And as I said before, we are bound to turn up at the bank in 3 months' time with $5 million in exchange for £3,266,906. And it might mean the phrase is close out the contract and we complete it by going into the bank with sterling, changing it into 5 million and immediately changing it back onto the forward contract. So it's a little bit of residual risk there. Money market hedging. Money market hedging will produce very similar, indeed in theory identical results to the forward contracts. It is more complicated. It'll take you a little while just to follow through what's going on in here, but we'll take it slowly. And essentially risk is eliminated by being able to, in a way, change money now instead of waiting until 3 months' time, or whatever it is, when the transaction actually occurs. We're going to be looking at two cases. What would happen if we were to receive foreign currency in 3 months, or whatever it is, or we pay it. So here we have an example. We are a German manufacturer. We're going to be dealing in euros. We are going to be receiving $5 million in 3 months. Now, we know that in 3 months' time, $5 million is coming in. Okay. If we had, in 3 months' time, a $5 million liability, we could use the $5 million coming in to pay off the $5 million liability. It's essentially matching. We don't have that $5 million liability at the moment, so what we're going to do is create one. We want like an overdraft to the bank of $5 million, which will perfectly soak up the $5 million coming from our customer. How do we create this overdraft? Well, what we do is we borrow enough dollars now. This will be a loan, it will be accruing interest. So in 3 months' time, the loan grows to 3 months here. So what we're adding on here is, of course, plus some interest. And it'll be interest at a dollar deposit rate. Now, two things have happened when we go to the bank and we take out this loan. Our account at the bank is growing up on a daily basis up towards 5 million. But also, we could walk out the bank with a huge number of dollars stuffed in our pockets. So when you take a loan, you get the money and you set up a liability. Now this means, therefore, we have the dollars today. And if we have the dollars today, we can change them today into here euros, and there's no more risk. We change the dollars today, and on kind of the back burner, you've got your overdraft, your loan accruing up, and in 3 months' time, the $5 million will come in from your customer just to pay that off. So that's the way it's going to be working. So let's see some figures. So the spot rate, let's not worry about spreads anymore, we won't concentrate on that, but the spot rate we want here to be changing dollars into euros is 0.7524, that's today's rate. And then you're given not forward rates, but you're given interest rates. We're given a US dollar interest rate and we're given a euro interest rate. Now here's where you have to be kind of super careful. If you go to the bank and say, I want to put money on deposit for 3 months, they might say, right, we'll give you 3.5%. If you say, I don't want to put it on for 3 months, I want to put it on for 6 months, they might give you 3.8%. The longer you promise to keep the money on deposit, usually the higher rate the bank will give you. But those percentages I quoted, the 3.5 and the 3.8 and so on, those are per annum percentages, so you can compare the rate you're getting for putting your money on for 3 months and money on 6 months. So although this calls itself a 3-month interest rate, they're always going to be per annum. We're never going to earn 3.2% because the money is not there for a year. We're going to earn a quarter of 3.2% because the money is only going on for a quarter of the year for 3 months. And it is a quarter. Okay, so to convert the 3-month annual rate into the rate you're actually going to get for 3 months, you divide by 4. So we've got two interest rates, and again there's a bit of a spread in the interest rates. If you're borrowing money, there's no difficulty in knowing what you're going to be charged. You're going to be charged a higher rate. If you're depositing money, the bank will pay you the lower rate. And again, we see this all the time when we're in the high street banks looking at borrowing or depositing. So let's work through this example. So we're going to be receiving $5 million in 3 months. We want a $5 million liability, therefore, to be existing in 3 months. So we borrow enough dollars now to become, after 3 months interest, to accrue up to 5 million. So if we borrow X now, we put it on deposit, and here's our 0.32%, but divided by 4, okay? Because we're only earning 3 months interest on that. It's a per annum rate that applies for 3 months. Then we can work out that if we were to borrow this amount now, then in 3 months' time it will have accrued up to 5 million. And you can work that backwards if you like. You can take, just to check that it's working, 4960317 times, and essentially we're dealing here with 0.008 times 1.008 comes to back to 5 million. So that's, as I say, kind of on the back burner. This is an overdraft starting at 4.960 here, gradually becoming 5 million, which will soak up the 5 million that comes in. But of course, we have this cash now. The double entry is debit cash in your pocket, credit to the loan account of the bank, really. So what are we going to do with this cash? Well, we can convert it today at the spot rate. If you have money today, you can convert it today. So this is going to give this German supplier here that amount, an absolutely certain sum. It doesn't matter what the exchange rates do in the future, it's not going to touch us. We have converted our dollars into euros, and on the back burner there's a dollar liability waiting for the 5 million to come in to perfectly pay it off. So that's basically what it is, and it doesn't involve any sort of exchange rate risk at all. The final little step, which is done here to kind of finish it off, and this is not really to do with eliminating risk, but is recognizing, well, under this method you have got your euros 3 months earlier than you would have had you done it under a forward contract. Under the forward contract we had to wait for 3 months, then you take your 9 million into the bank and then you convert it into your euros. Here we have essentially got the euros now, and strictly to compare the costs of the different methods, we have to take this time value of money into account. We could spend this amount of euros now on plant and machinery and so on. You can do whatever you want with it, but always in these questions you say, right, let's just put it aside for 3 months and see on deposit and see what it would become in 3 months. So here what we'll be doing is we'll be dealing with euros, and we would be depositing euros for 3 months. And again, the 0.2%, it's expressed as a per annum rate, but it's only for 3 months, so we need a quarter of it. So if we put this money on deposit for 3 months, at the end of 3 months, it'll amount to that. So that's really the amount you should be comparing if you say you're comparing what you're going to get under the forward contract, the money market hedge. This is really what you should be comparing to get them into the same time frame. But this last step is not reducing risk. This last step is done to compare the different amounts you get under different methods. So I was receiving money. Let's see what would happen if we had to pay money out. So here we have a UK importer must pay out $1 million in 3 months. Okay, must pay out $1 million. I think we should say 10 million in here. Let's make it 10. Everything else is dealing here, I think, in 10 million. It's 10 million. So UK importer must pay out 10 million in 3 months. So we know we're going to need dollars in 3 months. So why not put that aside now? Why not deposit enough dollars in the US bank account? It won't be 10 million, but we're going to be depositing some money in a US bank account so that when you add some interest, it's going to grow, becomes 10 million. Okay, so enough US dollars to become 10 million when you add on 3 months worth of interest. And then of course you have $10 million in the bank, and you use that simply to spend the 10 million that your supplier requires. So we need money now, and if we need dollars now, it'll be a bit less than 10 million. We can go out and change it now. We get the conversion over and done with today. Take your sterling now, change it to dollars, put your dollars aside for 3 months, use the dollars to pay your supplier. So here we have the example with some figures on it here. And again, I think let's just see what the answer does here. I imagine it's we're gone back to 1 million now, so okay. So we're looking here for 1 million. It's changed pretty slightly. So here we have a UK importer must pay $1 million in 3 months. Spot rate, again, we're not worrying about the spread, 1.523. 2 different interest rates again. This one here is if you're borrowing, this one here is if you're depositing. Show how the exchange rate can be managed using money market hedging. So we know we need $1 million in 3 months. Therefore, how many dollars would we need to put on deposit now to grow to that? So we're going to be dealing here with dollar interest rates because it's dollars, and the bank is going to pay us at the lower rate. But remember, this is per annum. So we're going to earn 2.5%, but only over 3 months. So, and that has to become $1 million. So here we have it, 1 million, or whatever the amount of money is here rather, invested at the 2.5% divided by 4, because it's only 3 months, is to become $1 million. So this is all dollars up here. So how much do we need to put on deposit now to become 1 million in 3 months? It's going to be this. And again, you can kind of check it. You can say if I take 993,789 and I put it on deposit here times 1 plus, it's coming out to $1 million. Okay, so we've done that correctly. Borrow $993,789 now, or convert to that now rather, not borrowed, but you're taking sterling and converting it to 993,789. So it can be obtained now, today, at the spot rate. So the number of pounds it's going to take us is that. So we give the bank this number of pounds, the bank gives us this number of dollars, we put those dollars in our dollar bank account, and in 3 months' time that is going to become 1 million, which is exactly what we need to pay off our supplier. Again, we have to be careful of the timing here. This is essentially taking money out of our bank account now and kind of putting it aside here for a rainy day, or not rainy day, but to pay this supplier. We're actually in a way having the cash outflow sooner than we otherwise would have. And the normal way to finish this off is to say, well, where are we going to get this 657,138 today? And the kind of assumption is that we're going to be borrowing it. So we need this money 3 months earlier. We can borrow it. This is sterling. We're looking at sterling 3 month rates. We're going to be paying 4.2% per annum on this 3 month amount. So to get to the proper cost, if you like, it's 657,138. Yes, but in a way to account for us having to spend this money earlier, the true cost is 664,038. So we take 657,138, we convert it now, we put those dollars on deposit, they become 1 million. There's no exchange rate risk. We've done all our conversion now. It doesn't matter what the real rate is. We will have 1 million in the bank to pay this person in 3 months. We've changed the money into dollars now. We're not dependent on any sort of future rate that could be coming up.